I think overall growth and inflation are going to be higher, not higher than they were necessarily this year, but higher than maybe many are expecting. And I think that's good news for equities, in particular, maybe green stocks. We've got this new infrastructure spending program targeting green businesses. Of course, Europe's got its new Green Deal. China's looking at cleaning up its production. A lot of emphasis on green. So as the Fed perhaps begins to consider climate change in their mandate the way the ECB did, that could become a positive trend. Green stocks didn't do particularly well this year. Next year could be good for them. I think also, just to add on to that, as we take a look out, non-U.S. stocks may finally perform well. This year we saw the U.S. lead, but looking outside the U.S., there's a lot more economic sensitivity and inflation sensitivity to those equities. Once we get past this recent COVID wave, I think you can see a return to better performance there in Japan and in Europe as well.
Jeffrey, you mentioned China. Is the slowdown there going to test or even undermine the pro-equities view globally?
It is a risk, but lately the data we've been seeing in terms of singles day numbers, retail sales, even the 1 month dip in housing prices, not enough to, I think, offset what's likely to be a movement towards targeted stimulus in China. If this was the year of new regulation, next year may be the year of targeted stimulus. And that could keep China perhaps running at a slower pace than we saw this year, but not enough to derail the global growth outlook.
I know you think that some of this year's shortages are going to turn into gluts by, say, the second half of next year. Give me specific examples. What are you thinking?
Well, just as we saw last year, maybe with personal protection equipment, masks and gloves were a shortage and then quickly became a glut. We've seen it with coal this year with the incredible turnaround and crashing coal prices and those miners. Look, it could be semiconductors. Already we're hearing from some of the automakers that they are getting the shipments that they need. VW, Toyota, GM, and Ford have said they're past the peak in the semiconductor shortage. They've got lots of cars sitting on their lots just waiting for those last few chips to then roll out to lots. So we can actually see finished goods, game consoles, phones, PCs, TVs, refrigerators, cars actually begin to really hit the supply chain and actually get to their destinations as we look out maybe to the middle and second half of next year. And that could really bring down the price pressure if maybe 2% of the inflation that we've seen here in the U.S., 2 percentage points, is coming from those log jams and supply chain shortages. Well, that could really reverse next year and create a very different outlook for inflation.
Is that baked into earnings and valuations right now?
Not at all. I don't think in any way that's baked into earnings or valuations. I think that's a particular risk to keep an eye on for those areas that are now in short supply that could quickly see things turn around, as we've seen just in those two examples I gave in the last couple of years.